Welcome back to the Deep Dive. This is the only place where we sift through all the complexity of the modern world to give you that precise, distilled knowledge you need, all without you having to wade through, mountains of jargon.
And today, our mission is a pretty crucial one. We are diving deep beneath the surface of Web3 and the whole blockchain ecosystem in 2025.
Right. And we're not here for the hype or the price chart.
No, not at all. We are here to extract the critical shifts. We're talking about talent, about the fundamental technology, and I think this is the most important part, global regulation.
And just to set the stage for you, our sources all confirm this space has just exploded. It's way past the niche phase now.
Oh, absolutely. Projections are showing the global Web3 market is set to hit nearly $100 billion this year. It's something like $99.75 billion to be exact.
Wow.
And it's growing at a compound annual rate of over 41%.
That level of growth, that kind of capital injection,
Yeah,
it's completely transformative. It has to fundamentally force a shift, doesn't it?
it does.
We're moving from, I don't know, playful, sandbox-style experiments to building real, specialized, serious infrastructure, the kind that's designed for global enterprise.
That's it, exactly. The money is pushing the entire industry toward a reality check. And that massive growth, it really shines a spotlight on two core, pretty painful problems that have to be solved if this tech is ever going to live up to its promise.
Okay, so what are they?
First, just universal speed and efficiency. And second, figuring out how to operate under this rapidly increasing and frankly very sophisticated global regulatory oversight.
Okay, let's unpack that first challenge then. Efficiency and scaling. We have to start with the fundamental bottleneck, right? The thing facing all the major chains today. If you want millions or even billions of people using a decentralized app, you just can't have these crippling fees and long wait times. So what's the big technological fix that's dominated R&D this year?
That would be the layer 2 scaling solutions. Most people know them as rollups.
Roll-ups.
And these are solutions built on top of the main chain. So layer 1, they process transactions somewhere else, they bundle them up, and then they submit a single compressed verifiable proof back to that main chain. It just dramatically reduces the load.
And the interesting part here, from what I've read, is a sort of technical, almost philosophical divide.
Yes.
The way they prove that validity splits the market into two major camps. You have optimistic rollups and then zero knowledge, or ZK rollups. How does that distinction actually translate for a user, in terms of their security and speed?
Oh, it's a huge difference, a really huge difference. Optimistic rollups, they basically operate on the principle of innocent until proven guilty.
Okay.
They assume all the bundled transactions are valid unless an independent participant explicitly posts a challenge, and that challenge is backed by what's called a fraud proof.
So it's easier to build because you don't have to mathematically prove every single transaction right away.
Yeah.
But what's the trade-off? What's the cost of that assumption?
The cost is time. If a fraudulent transaction is suspected, there's this waiting period. It's usually up to 7 days.
A week.
A week, to allow time for that fraud proof to be generated and submitted. And this makes withdrawals and final settlement really slow, which is a major, major problem for anything high frequency.
That makes sense for, say, general-purpose dApps that don't need instant settlement.
Yeah.
But then you have the ZK rollups, and these are always lauded as being, mathematically superior.
They are. They really are. ZK rollups use this incredibly complex cryptography to generate a mathematical proof that verifies the transaction's validity instantly before it even hits the main chain.
So that gives you what? Better security?
Superior security and instant finality. It makes them ideal for systems that demand high throughput. So we're talking trading, rapid global payments, secure identity verification systems, that kind of thing.
But hold on, if ZK rollups are so superior mathematically and they offer instant finality,
Yeah.
why do optimistic chains still hold so much of the market share, so much of the total value locked today? What's holding ZK back?
That is the key friction point. ZK technology is just significantly harder to build and to run. Generating those cryptographic proofs, it requires very high computational costs, which can increase the overhead. Plus, making ZK rollups fully compatible with the Ethereum virtual machine, the EVM, that has been a massive engineering lift.
So we're getting there, but it's slow.
We're seeing rapid progress, but the complexity means that, for now, optimistic rollups are still the easier, faster path to market for a lot of developers.
Understood. It seems like ZK is maybe the long-term destination, but we're still wrestling with the engineering costs of the journey.
Yeah.
Okay, so scalability isn't the only infrastructure problem. The second big hurdle is sustainability.
Absolutely. The global scrutiny over energy consumption has Well, it's reached a point of no return. It's forcing a definitive shift away from the energy-intensive proof of work, or POW mining,
Towards proof of stake.
towards proof of stake, POSS.
Exactly. And just to really underline what energy intensive means for you listening, our sources cite that a single Bitcoin transaction, which still runs on POW, consumes roughly 1,375 kilowatt hours.
Which is an insane number.
It's enough to power an average U.S. home for about 6 weeks. One transaction.
It is staggering and completely unsustainable for any kind of global adoption. POS solves this by just eliminating competitive mining entirely.
Right.
Validators get selected based on their token stake, not their raw computational power. And the energy reduction is it's monumental, up to 99.95% compared to POW.
In Ethereum's transition to POS, the merge, I mean, that remains one of the greatest infrastructure upgrades in the history of computing, probably.
I would agree with that.
And we're even seeing networks take POS and optimize it even further. You mentioned Algorand, which uses a pure proof-of-stake model.
Yeah.
And it consumes a ridiculous, what is it, 0.000008 kilowatt hours per transaction.
I mean, that is essentially net zero on a per-transaction basis. The technological leap is just undeniable.
Okay, so the tech is getting scalable. It's getting sustainable. Now, this is where it gets really interesting for me. How is this newly robust infrastructure actually being applied outside of, pure crypto trading and speculation?
The primary engine driving blockchain into the traditional economy is, without a doubt, the tokenization of real-world assets, RWA.
Walk us through that. What is RWA tokenization? What kind of assets are we even talking about here?
Okay, so RWA involves converting tangible assets. So think real estate, gold, stocks, even complex financial instruments like debt into tradable tokens on a blockchain ledger. You're basically creating a digital twin that represents ownership of that physical thing.
So instead of me having to buy a whole $5 million building, I could theoretically just buy a fraction of a token that represents, say, 1% of that building's equity.
Precisely. That is the impact. It democratizes access by allowing for that fractional ownership, and it dramatically increases liquidity by enabling 247 global trading.
And this isn't a small-time thing.
No, not at all. The RWA tokenization market is projected to grow from just over $9 trillion to nearly $19 trillion by 2030.
Wow.
It is the defining bridge between Wall Street and Web3.
That growth is it's immense. But beyond finance, where else are we seeing blockchain being embedded just for its transparency and security features, not as a currency?
Well, look at enterprise logistics. Supply chain is a major use case.
How so?
Because blockchain provides end-to-end tracking, proof of origin, which is great for anti-counterfeiting measures, and it generates these tamper-evident business records. For a large firm that's navigating complex global tariffs and compliance, that level of transparency is invaluable.
And what about healthcare? That's an industry that's just notoriously plagued by security holes, fragmented data, and these intensifying cyber attacks.
Exactly. The blockchain and healthcare market is projected to reach almost $13 billion this year, and it's driven by that exact pain point. Traditional electronic health record systems, the EHRs, they were just never designed to manage a lifetime of medical records from different hospitals securely.
So blockchain offers a fix.
It offers a solution, yeah. By allowing for lifelong patient-owned records, it improves interoperability between hospitals while at the same time enhancing privacy. And that's crucial, especially given all the high-profile cyber attacks we see hitting hospital systems around the globe.
And finally, on this topic, we have to talk about the AI convergence. Our sources identify the integration of AI and blockchain as one of the dominant narratives right now. How do these two huge technologies actually merge in practice?
They merge because AI needs trust, and blockchain provides an auditable source of truth.
Okay, so give me an example.
We're seeing AI-enhanced smart contracts that can automate really complex financial processes. We're also seeing decentralized AI networks where the data and the model development are transparently recorded on-chain. This eliminates single points of failure. AI tools are even assisting DAOs, decentralized autonomous organizations, in streamlining governance and detecting financial risks.
So it's like a secure, verifiable sandbox for the AI to operate in.
That's a great way to put it. And of course, to meet this explosive demand across RWA, healthcare, and this AI blockchain nexus, the entire talent pool, the human layer, has had to fundamentally recalibrate.
Right.
That rapid adoption has created an acute, really massive shortage of high-quality talent.
So the old idea of the general blockchain developer is basically obsolete now.
That is the key hiring trend for 2025. Specialization over generalization. Companies are specifically demanding experts in very niche fields.
Like what?
We're talking Bitcoin Layer 2 engineers, highly skilled Solana smart contract verifiers, and crucially, tokenomics specialists.
A tokenomics specialist. That
Yeah.
sounds like a very 2025 job title. What does that person actually do?
Yeah. They are the architects of an ecosystems economy. They design the incentive structures, the vesting schedules, they manage the treasury assets, they ensure the long-term viability of the entire economic model for the protocol.
So it's a mix of game theory, finance, and sociology.
Pretty much. You also have a massive demand for those specialized blockchain plus AI engineers. And the must-have skills are languages like Rust and Solidity, along with advanced smart contract auditing expertise.
The complexity is just too high for generalists anymore.
Yeah.
And this brings us right to the governance model of Web3, DAOs, decentralized autonomous organizations. The original promise was revolutionary, wasn't it? Internet-native organizations governed purely by smart contracts and community votes.
The promise is fantastic. Transparency, global participation, censorship resistance, and successful projects like Uniswap DAO and Maker DAO have shown that collective decision-making can effectively manage billions in assets.
The reality often falls short of that democratic ideal. If the technology is supposed to be so superior, why do so many DAOs seem to struggle to function efficiently?
They face these very structural, very human challenges. First, simple voter apathy. Critical decisions are often made by a very small active minority. Second, you have significant centralization risks. Large, early token holders, the whales, can dominate voting outcomes, which completely undermines the whole democratic promise.
And then there's the security.
And of course, security. As the infamous 2016 DAO hack showed us, a single vulnerability in a smart contract can lead to a catastrophic, irreversible loss.
So if they are failing in practice, how are they evolving? How are they trying to fix these foundational issues?
They're adopting models that trade some of that pure direct democracy for more efficiency. We're seeing delegated governance, for example, where token holders assign their voting power to trusted, knowledgeable experts. Reputation-based systems are also emerging. They reward consistent, quality contributors with greater influence rather than just rewarding raw token weight.
But wait, if the whole goal of a DAO is to eliminate middlemen and central authority, doesn't delegated governance just reintroduce a new, centralized layer of trusted experts? Only this time, they're chosen by who has the most tokens.
That is the crucial question. It's the paradox of scaling decentralized governance. And DAOs are explicitly grappling with that trade-off right now.
So what's the solution?
They're moving towards hybrid models. They try to balance decentralized voting on the big issues with a more centralized execution body just for speed. They're realizing that perfect decentralization often equals functional paralysis.
That structural maturity is a perfect segue to our final and very necessary reality check regulation.
Yeah.
2025 was the year regulation moved from theory to global practice. We've seen that over 70% of jurisdictions have progressed stablecoin regulation this year alone. That's a huge signal.
That stablecoin focus is critical. They're seen as the on-ramp for traditional financial institutions. But the defining regulatory framework we have to discuss is Europe's MiCA, the Markets in Crypto Assets Regulation.
Okay, what's the core mandate of MiCA?
MiCA institutes these uniform, sweeping, EU-wide rules for assets that were previously unregulated. It focuses heavily on transparency, disclosure, proper authorization, and really rigorous supervision.
It's raising the bar.
It's raising the bar for market integrity across all EU member states. Absolutely.
And are countries actually putting this into practice, or is it just sitting on the books?
Oh, no. Implementation is happening now. Germany is leading the charge. They've already approved 20 crypto asset service providers, which is about 30% of the entire EU total.
Wow.
And France and Austria are also rapidly embedding MiCA compliance into their national laws. It's a clear signal. If you want access to the EU market, you must adhere to this very high standard.
And beyond Europe, what other global trends are pointing toward compliance?
Well, we've seen the Financial Action Task Force, FATF, really double down on strengthening anti-money laundering and counter-terrorist financing standards globally, and their analysis is key.
What did it find?
It confirms that regulated virtual asset service providers, VASPs, have significantly lower rates of illicit activity compared to the rest of the crypto ecosystem. It proves regulation actually works to curb abuse.
And let's not forget the pivotal narrative shift in Central America. El Salvador removed the mandatory requirement for merchants to accept Bitcoin.
Right, shifting acceptance to a voluntary status. And that move clearly shows global pressure influencing even the most crypto-friendly nations to align with international financial norms, specifically IMF conditions. That balancing act between innovation and risk management is the theme of 2025.
And this regulation is desperately needed because, despite the underlying tech being secure by design, the operational security failures are mounting. And we can quantify the damage. It's pretty sobering.
It is. We have catastrophic losses reported just in the first half of this year. Over $2.17 billion was lost to exchange hacks.
Oof.
An additional $1.6 billion was lost due to access control failures, social engineering, phishing attacks, so human error, basically. And most damningly, over $1 billion was lost due to simple smart contract bugs.
$1 billion
Yeah.
lost because of flawed code that was supposed to be immutable. I mean, that sounds like the biggest indictment of trustless systems imaginable.
It is the ultimate irony. And we're also seeing new, more sophisticated threats. Things like blockchain extractable value or BEV, exploits, front-running, sandwich attacks. They've cost users over $540 million. And these exploits just undermine the core promise of fairness in DeFi.
And for you listening, front-running basically means exploiting the transparency of the transaction queue. If I see your large trade is pending, I can quickly submit my own trade to profit from the price movement I know your big trade is about to cause.
Yeah.
It's gaming the system.
Exactly. The mitigation measures now are non-negotiable. Regular third-party code audits, mandatory multi-factor authentication, secure key storage. These are baseline requirements now for everyone. So, to synthesize all this for you, the story of 2025 wasn't about inventing new, flashy concepts. It was about making the existing infrastructure actually work reliably in the real world. That meant solving scalability with rollups, creating specialized talent pools to handle the new complexity, and establishing these mandatory compliance frameworks globally. And that clarity worked. Institutional interest followed the regulation, with 80% of jurisdictions seeing new institutional initiatives pop up right after regulatory progress.
So what does this all mean for you? The technology is absolutely maturing into something robust, but the complexity, and therefore the risk, is rising at an alarming speed. We've seen that the biggest risks to these fundamentally secure systems aren't the blockchain itself. It's the human-created flaws. It's bad smart contracts and poor security like phishing.
And that creates this fascinating paradox that we really have to confront. While Web3 promises trustless systems, meaning you don't need to trust an intermediary like a bank, the entire ecosystem's security relies completely on the expertise and the integrity of these highly specialized and inherently centralized teams who are building and auditing the code that runs everything.
So if Web3 promises a world without the need for traditional trust, the challenge going forward is ensuring that the specialized teams developing and auditing the underlying infrastructure are truly worthy of the trust the decentralized system ultimately relies upon. Thank you for joining us for this deep dive.